Good morning. Welcome to the Mortgage Rate Forecast with Scott Criss, your mortgage rates and news. It is December 1st. Let's get started with the charts. Whew, crazy, right? Sell off from averaging, about a 103 for the majority of last month, to now selling under $99. So currently, bonds are trading at $98.88. Our support is actually above us, so we are actually trading below our support. We opened at our bottom support, and now we're just nosediving, guys. Resistance is above us, and on the red lines here, we're probably not even going to touch that today, to be honest with you. So reports came out, the ISM challenger job cuts, none of which were bond friendly, but the jobless claims and construction spending really missed some expectations. Little bit bond friendly, but just not enough, guys. We opened at the top of this right here where you can see my mouse, and we're trading right down here for right now. What's the cause of this? So you're going to keep hearing it. Everything's trading pretty well, pretty fine. Election came out, Yellen came out, and so it's just a roller coaster, guys. It's just crazy right now. We're in uncharted territories. It's really hard to predict. To kind of quantify where we're at, Freddie Mac came out yesterday and said today, so the average consumer received a 3.77 rate at 0.5 points in November. Their link is down here. So to kind of quantify where we're at, if average trading last month was approximately 101.75, this green line here, then that means from where we're trading now compared to our average trading last month, we're off by a little under $3. Okay, so if the average consumer was paying half of a point plus that $3, I mean, average consumer is going to pay almost 3.5 points for that same rate today. So that kind of shows you where we're at and where the bond market's headed. So got to be really, really careful here if you're floating your mortgage. And a lot of it is just because the investors, they're listening to what President-elect is saying, and they're like, okay, the economy is really going to do well. So they're pulling their money out of this low yield bearing interest of bonds, and they're putting it somewhere else. Hey, it's going to probably be good news for your 401k, but if you get a mortgage right now, timing's a little bit off. So analysts today finally have come in and are pretty much eye to eye. Both are consistent bearish on short, they're bearish on long. So here's what I'm going to do. I'm going to step in the ring with them and go with them. I'm going to say that it's going to be a bearish market right now for a while. I'm going to forecast the bond range through the coming months to be about, through the coming days to be about $98 to $99, which means from where we're trading now, mortgage-backed securities could get a little bit better by maybe an eighth, but I think we could fall over the next week as low as $98 or 7/8 of a point worse. So I would say if you're floating right now, be super careful. You're floating against the analyst projections. And you know what? I'm going to project the same. I think the bond market's going to sell off. We're kind of in some uncharted territory. So anyway, that's the forecast for now. Be super careful if you're floating. So what do you think? We'd love to hear from you. You can leave your comments down below. When do you think rates are going to stabilize, get better? They have to stabilize eventually, right? So tell us what your thoughts are. Everything likes to be liked, so does this video. You know what to do, and that's it for now, guys. If you'd like to subscribe, at the top left of your screen, you can click subscribe. That'll give you a little notification when we do updates. And at the top right is Mortgage Bonds 101. And so if all of this didn't really make sense to you and you kind of want to learn how mortgage-backed securities, their trading impacts you as a consumer getting a mortgage, click that Bonds 101. That'll teach you the basics. Anyway, that's it for now. Have a great week. We'll talk to you soon. Bye-bye.